the hour. So formally welcome everybody. It's great to see you all here for our first meeting of 2021. Slightly melancholy anniversary. I noted this weekend was actually the first anniversary of when I returned from our last physical board meeting in New York. You know, and I think that's sad but necessary. Ross will say a little about, you know, our hopes for returning to physical meetings later in the year, obviously very much contingent on what's going on around the world. But I would just like to say a huge thank you to the board and staff for everything that you've done in terms of, if you like, keeping the show on the road over the last year. You know, it's been very difficult times, both professionally and personally, and I think it's a great tribute to everybody's professionalism that, you know, we've managed to make as much progress as we have with all the, you know, the various adverse factors. I think, you know, I'd particularly like to note that in the context of when you look at the, you know, the agenda item, the reports on activities and communication, that remained extremely strong. Covering a lot of different areas, different topics, different approaches. So I think thank you to everyone for keeping going with that. Outreach is tremendously important in terms of our visibility around the world. And it's a kind of paradox that although we obviously can't do that physically, in some respects, actually, you can reach more people through virtual events and so on. And I think certainly, as you'll see with some of the activities there, it's actually enabled us to participate a lot more actively, for example, with the World Bank, but also with regional organisations and so on. And that will be very relevant, and we'll come back to that when we start to pick up on our discussions on how to take the work plan forward later in the meeting. But I think it's right, although we won't go through that in detail here, to note that. And there are some interesting things within that. So we will come back to that, it's very relevant. The other thing, just in terms of the items taken as read, obviously we will also pick up on the state of play on IPSAS alignment with IFRS, and also with developments in terms of alignment with GFS later in the, both of them later in the agenda. So with that, I will move firstly into item 1 and pick up on the draft minutes from both the December 2020 meeting, but also for the virtual check-in. Ross, over to you at that point.
Thanks, Ian. And on this item, we have had a change to both the December minutes and the February 25th check-in meeting minutes. The December 2020 minutes, we've had comments to add a line in both to the ED78 and ED77 sessions to note the alternative view. This is consistent with the approach we took the last time we had an alternative view on social benefits, and we've agreed with both Todd and Mike what that sentence will be. But we'd like to circulate the minutes with that change so the members can see it before we officially approve them. So following the session today, I propose we circulate an email with the minutes with the change attached so everyone can see that slight change to pick up the alternative views. Also very helpfully, Mike's provided some useful edits on the February 25th, 2021 check-in meeting minutes, which I think improve them. And I'd like to also include those and circulate them at the same time, just so the board can see them both as a package. And I propose that we approve those minutes later in the meeting after everyone's had a look at the revised changes. I don't think they're substantive in nature, but since we're going to circulate both copies, I think it's just better if we wait likely to the last day of the meeting when I revisit the technical director's report that we just clear off the minutes there. So unless there's any objection to that, I'd like to proceed on that basis.
Thanks, Ross. Can I just check everyone's okay with that proposed approach? Okay, so seeing some thumbs up on that. Good, thank you very much for that reaction, everybody. Good use of the reaction button there. So yeah, we'll come back, and I think recognizing, if there are any additional suggested edits on the notes of the meeting in February, if you can make sure that Ross has got those so that those can be incorporated in the version that comes back around. Okay, so I think we then move on to item 2, which is your report, Ross, as Programme and Technical Director.
Yeah, thanks, Ian. There's 3 key items I want to highlight in the report today, and I propose we take them one by one, if that's okay, Ian. So the first item I want to focus the board on are paragraph 6 through 8 in agenda item 2.2.1, and these are the changes to the various timelines of 3 specific projects since the December 2020 meeting. And those changes relate to the revenue and transfer expenses EDs and their return back to the board. As you'll recall, in 2020, we extended the meeting or the comment period an additional 2 months, which meant we couldn't have a full discussion of the responses in December 2020. So my proposal that I've reflected on the work program itself is to extend the finalization from September 2021 to December 2021. So that's the first change. The second change relates to the package of exposure drafts, ED 76 to ED 79, and all of the related projects to measurement. Because we've agreed a 6-month comment period, when we looked at the timelines for those projects when they come back, again, we're in a similar situation to what we have with revenue and transfer expenses, where it's unlikely we'll have sufficient time when they come back from consultation to have a full discussion at that first meeting. So I'm proposing another 3-month delay in the finalization of those related EDs because we have agreed that all 4 of those EDs go out on a 6-month comment period. And the last group of changes is the timeline to the mid-period work program consultation. And we'll discuss this more in depth when we have the discussions later this week on the mid-period work program consultation. However, we have adjusted the timeline to reflect what we'll discuss in that session and what we think it'll take to complete that. So I just wanted to highlight those key changes to the work program because there are a lot of moving parts this time around.
Okay, thanks, Ross. So pause and take any comments from members at that stage. So I'm not seeing any flags up at this stage. Okay, good. So if you move us on then, Ross.
Yeah, thanks. The next items I wanted to highlight for the board in particular are more related to the fact that it's becoming more clear that we're going to continue to work virtually for at least through June. And there's a possibility for the second half of 2021, we might be in that position as well. So similar to 2020, and as I've highlighted in paragraph 8 in particular in the Program Technical Director's report, we'll need to extend the meetings by additional dates to make sure we can get through all of the material that we are planning. And we've kind of mapped out a number of agendas taking us through the end of the year. And similar to 2020, we're likely to need more meeting time in September and December in particular. And I thought it would be helpful for members, TAs, observers, as well as staff planning if I highlight the additional days we are likely to ask members to hold as we get closer to various approvals in the second half of the year. So in paragraph 8B, 8 and 8D, I've highlighted the additional date I'm asking people to hold for June, as well as the additional dates for September and December 2021. And of course, if we go back to in-person meetings, it's quite likely we'll be able to release those additional dates. But I did think for people's planning and time availability that it would be good if everyone could lock in those dates and hold them for the time being. And I did want to note that in 8A, I've flagged the additional meeting check-ins, those one-day meetings we've started to do in between meetings. We agreed those in December 2020 for the days we'd hold for December or throughout 2021. And I've just highlighted those in 8A so everyone's aware again what those dates will be in advance and can continue to hold those. Similar to 2020, if we do think we won't need those additional dates, we will release the time. But so far, they've been quite helpful for staff in particular, and I think beneficial for the board in keeping things moving. So we do intend to use those throughout 2021. And I have a feeling they'll continue even when we go back to in-person meetings, you know, should everybody be willing to continue to invest the time.
Thanks, Ross. Just pause and check. Mike, you want to come in?
Thanks, Chair. So thanks, Ross. I've locked in those meeting dates into my calendar. Just for purposes of the new members here, and maybe I also locked in the CAG meetings in June and December.
Thanks, Mike. That's a great point. And for those new members who aren't aware, we have a CAG meeting every June and December, and it's always the Monday preceding the first day of our normal in-person meeting. So I don't have the dates off the top of my head, but I think it would be December 6th in the December meeting, and it would be June 14th for the June meeting. And also to make you aware, if you're looking for these dates not in the report, all of these dates are on our website. So if you go to the IPSASB meetings tab, you'll see the dates that we've put up. We haven't added the additional dates yet that I've just mentioned, but the core meeting dates that have been planned since last year are there. And if you go to the IPSASB webpage and you click CAG meetings, you can find the CAG meeting dates there, as well as all the past material for the CAG if you're interested in having a look at what they've looked at in the past.
Thanks. And of course, we have the chair of the CAG, Thomas Muller-Marcosberger, is with us. Hi, Thomas. And I think it's certainly true that board members have found it very useful. It's not compulsory to observe those CAG meetings, but I think board members have found it very useful to hear the comments from a broader range of perspectives. And you know, that's certainly, obviously Thomas reports the key comments back from the CAG to our meeting, but I think hearing the discussion is, you know, it can be really helpful, and we've got some really good insights from that. Thomas.
Yeah, thanks, Ian, for that. And to the new board members, I just can kind of send out a strong invite to all members to participate, because I think it's also very motivating for CAG members to see the interest of the board members whom we are working for. And I think especially in physical meetings, obviously, there is the opportunity for an exchange in the breaks or in between and after the meetings. I think that's very helpful and helping us to kind of do our duty in supporting the board. So I can only kind of support what Ian just said, and thanks, Mike, for bringing up the point.
Thanks, Thomas. Lucy.
Yeah, thanks, Chair. Good evening, good morning, good afternoon to all of you. While we are talking about the CAG meeting, I just want to suggest correction in the IPSAS in our work program through 2023 from March 2021, where in the conceptual framework, limited scope update, next stage, the CAG is indicated in September 2022, so I think it should be December 2022. Thank you.
Thanks, Lucy. That's noted.
Got it.
Good. Okay. So Ross, move us on then through your report.
Thanks. So the last item that I want to cover in this session relates to paragraph 10, where we've developed 5 factors that, from a staff perspective, we think we'll need to consider as we begin to think about returning to in-person meetings. And I've noted 5 specific items with a staff view on each of, what we'll need in place in terms of that factor to be able to go back to in-person meetings. So, and I'll just run through them quickly, and then we can maybe have a short discussion and get feedback from members on whether we cover those appropriately or there's other things we might also need to consider. So the first one is travel restrictions. So at the moment, most countries have significant travel restrictions with quarantine periods and limitations on the borders being open. And from a staff perspective, we think it's quite important that wherever the country we're meeting would occur would need significant relaxation of those requirements. So the removal of the border entry barriers, as well as reduction in quarantine periods. We don't think it's reasonable. For example, at the moment, if you are coming to Canada, you have to quarantine for 14 days before you're able to join an in-person meeting. So it kind of feels like a fairly straightforward one that at some point the governments will need to open up, and in particular the jurisdiction we're having the meeting. So I'll probably skip a point to 10 subpoint 4 here, because I think that goes hand in hand with the availability of an appropriate meeting space. So as you know, the IPSASB doesn't have its own physical meeting space within our offices. We rely on the space of CPA Canada, which is in the same building as our office, and IFAC in New York. So at the moment, both those meeting spaces are closed because of the current situation in both New York and Toronto. So even if we wanted to meet in those spaces and the restrictions were gone, we wouldn't be able to meet there. So it's a bit of a statement of the obvious, but one of the factors we will consider is when one or both of those spaces are reopened and available for meetings, that will need to be in place along with the borders reopening there. And 2 other factors that I'll look at together in the interest of time is the number of members and the availability of staff. So staff view is that before we consider moving back to an in-person meeting model, we do think that we would need the ability for at least 12 members to travel to the meeting in person. That would give us a quorum of members within the room. Should technology and whatnot fail us during the meeting, we'd be able to continue to move things forward. So we do think at a minimum, we would need the quorum to be willing, able, and available to travel. And along with that, we do think that at least some of the senior staff, myself, Dave Warren, and key staff on key projects would need to be able to travel to the meeting space, assuming it's not in Toronto. So if we did have to meet in New York, we would need the staff to be able to be there to help facilitate the meetings. And the last one, which is probably also a factor that we can't control, well, actually all these factors we can't really control, but this one is really difficult to control at the moment, is the pace of vaccinations and the availability of vaccines. And the staff view is maybe more practically that it's unlikely that most attendees would be willing to travel and participate in a meeting without some sort of protection from vaccinations. Other than that, those are the 5 key factors we've been monitoring and thinking about. But I guess at that point, Ian, willing to open it up and see what members think. If this seems like a reasonable list of factors, and if we've got them right, there's other things we need to think about. But at the moment, this is the kind of thing staff's monitoring in terms of when we might be able to go back to in-person meetings. Thank you.
Okay, thanks, Ross. And just before I open up for comments from members, I might just pull in James Gunn, if you don't mind. So for the new members, James is Managing Director Professional Standards within IFAC and is the line manager for the professional staff, not only for IPSASB, but also for the 2 other standard setting boards that IFAC supports, the International Audit and Assurance Standards Board and the International Ethics Standards Board for Accountants. So James, I don't know if you've got any other perspectives from the broader IFAC perspective and our sister boards before I go to Scott.
Thank you very much, Ian. Hello, everyone. what Ross has described in terms of the considerations is being considered by the two other boards, Audit and Ethics in New York, and by IFAC overall. I would maybe just add two, I guess, simplifications, but principles that I think are important from our board's point of view. I think one is equity, equitable treatment amongst members, so it's fairness. So we do want to make sure that the benefit of Zoom, which is we are all on one platform, we are being inclusive. Everyone's able to participate. There's a sort of a level playing field. Everyone is engaged and have an opportunity to be engaged. That's a very important dimension. I think when we start considering return to work, we may have a quorum, but it is very important that everyone feels that they are have the right and the same opportunities to participate. And we have to work through quite carefully, I think, if we've got an imbalance as a result of partial attendance, of course. And I think second, which is a summary of Ross's points, is safety. And I think as essential as all of the provisions that reasonably can be put in place is really going to, we'll know when we see it. And I think for the time being, our mandate and our mission is to continue a productive and sustainable approach to Zoom. And so the balances of meetings, shorter time frames, crisp agenda papers, expedited discussions as needed, I think is our most important factor, because we do probably have another 6 to 9 months of continuing some sort of Zoom virtual connections. So with that, I think we're optimistic to move forward, but we are taking all the necessary steps in an orderly and prudent approach. Thank you very much, Ian.
Thanks, James. So Scott, over to you.
Great, thanks, Ian, for that. Just maybe a subset of travel restrictions. You were talking about quarantine on the way in. I think it may also be appropriate to consider the quarantine on return, because it may be unrealistic to expect someone to be quarantined 14 days on the return back to their country as well. So I would suggest that also be added to the mix.
Thanks, Scott. And I see support for that. Camira.
Thanks, Chair. Just a minor observation in terms of the vaccination. I think we should consider also the feasibility of that, and maybe if it's not possible for all the members to be vaccinated to attend in-person meetings, maybe just the test will be fair enough. Just test before the meetings every day, or I don't know, or just short. That is much more feasible than vaccination at this point in time. Thanks.
Yeah, thanks, Camira. I think the testing factor that we need to think about. Any other points? I mean, obviously, you know, we will keep this under review and we'll keep the dialogue going with members as we see the situation changing. I think, you know, there's no doubt about the fact that we will, you know, I think having talked to members during January, everybody said the same. We do want to get back to physical meetings as soon as we can, but we do have to respect all, I think, which kind of right now feels like quite a daunting hurdle, unfortunately, but hopefully things will change. Lucy.
Yes, Chair. I just want to comment on the number of members, the minimum number of members that are required. If it will be, they will be attending in face-to-face, 12 members. If we will be adopting a blended approach where some would be attending it through Zoom, so I think there is no need for the minimum number of persons that should travel for the in-person meetings. Just my thought that this is no longer needed for as long as the other members are could join through Zoom or virtual meeting. Thank you.
Thanks, Lucy. Ross, I don't know whether you want to just sort of make any observations on that, because it is something we have talked about quite a lot.
Yeah, so I take your point, Lucy, and I think in our terms of reference, the quorum of the meeting doesn't require everyone to be in the room. So you're right, we could have a quorum without having 12 members in the room, but our thinking was, or at least my thinking was on this that if we're going to plan to move from a primarily everybody on Zoom and to go through the logistics of having people travel, we'd want to make sure we have a quorum for the meeting in the room for the discussion. So we thought 12 or more is needed before we consider going back to an in-person meeting. And that's simply from a planning perspective, that if the technology fails and the meeting we can't have people join via Zoom and be on screen in the room. And we have had technological issues when we have an in-person meeting. It is more challenging. That we want to be able to continue the discussions with the people who've actually traveled to the meeting space, and we can carry out the meeting while we work on technology issues. So I do think it's a good guide to have 12 or more willing to travel and being available in the room. So that's kind of where that one's coming from.
Yeah, Lynn, sorry, Todd, then Lynn.
Thanks, Ian. I'd just like to support what Ross is saying. I think it's important that you do have a quorum in the room. And I'm just thinking back to this time last year where there were, I think, 3 members, including myself, that didn't travel to the New York meeting because, things were looking like they were going to develop as they had played out with coronavirus. And if we were getting into a hybrid meeting situation, and you were doing 8-hour sort of meetings physically, I think people that might join by Zoom may want to pick and choose what they do, because I personally found it quite taxing because I was up basically the whole night, just the way that the time worked. And it may be necessary for those that are Zooming to pick and choose a bit, particularly if they're very unsociable hours. So I'm very supportive of a minimum number of members in the room.
Thanks, Todd. So go to Lynn, then Mark, then Scott, then Lindy.
Thanks, Ian. I guess my point was similar to Todd's. I think we ought to reflect, if we're going to be in a hybrid situation, just about the length of sessions and the number of days that we do that over, just to make that accessible to people on Zoom. I don't know about everybody else, but 3 hours on Zoom is normally sufficient for a day, really. It's quite taxing and tiring, particularly if you're at unsociable hours. So I think we ought to not wed ourselves to the old meeting format and the old meeting times and durations and number of sessions. I think if we're in a hybrid environment, we need to give more thought to how we structure the meetings and the length of sessions.
Thanks, Lynn. I think that certainly echoes some of the discussions that I'd had with staff, where we were thinking that we might need to spread the physical meeting out over 5 days and look at shorter days with some kind of core, non-core sessions, perhaps. Maybe use some of the additional time for task force meetings or something like that. But I think you're right. We do, if we had a kind of hybrid meeting, with at least some members attending virtually, I think we would definitely need to do that. Mark, then Scott, then Lindy.
I also support a hybrid meeting with a minimum number, as my colleagues already mentioned the reasons. I would also like to say that I think it's very important that if there's a hybrid meeting, that the technology really works, that it's tested. Because when I remember in previous meetings, I thought the members who attended by telephone, they were almost not there. And maybe it would be even helpful to show the screens with the members, because that we also have the feeling they are here and at least that they are really connected and they get the chance to participate. Because if you find out 6 members can't participate, okay, we still have a quorum of 12, but I wouldn't think it's then a fair coming back to also previous comment, so that it's tested.
Thanks, Mark. So Scott, then Lindy.
Yeah, thank you, Ian. Yeah, from a person who's taught hybrid for the last year, I really caution you about thinking this through. There's all types of issues with it that, first of all, Ian, it puts you in an unbelievable position as a moderator of virtual and live at the same time. That's lots harder than you think it is. Again, trust me, I've done it. The other thing is, I think it was mentioned, the disconnected of the people online really don't feel that much. So I'm supportive of the 12, but just be aware that it changes the dynamics of the meeting.
Thanks, Scott. I think, you know, that certainly that sort of practical experience is what we want to draw on, and certainly in the initial planning, you know, we were lucky that the audit and ethics boards actually met virtually the week after we had our last physical meeting, and we took a lot of learning from what they'd done. But I think you're right, and you know, I think we'll come back to you as and when we start to move, because that practical experience is really, really helpful. Lindy, and then we'll sort of wrap up and move on to the next item.
Thank you. And a lot of the comments made, and appreciate the comment made by James for saying, you know, it needs to be quite equitable. That also leads me to think, I wonder if 12 is too little, especially if you want to vote. And you have members online and members in person, and how that will work. So I think you just need to be careful if we get to meetings where we need to vote on pronouncements or on issues, how will that work?
Thanks, Linda. Yes, I think that's a good caution. I mean, certainly, just sort of wrapping it up, I think, you know, it's been good to get those comments in from members. I think they've reinforced a number of the sort of comments that have been made during my discussions with staff on the practicalities and the issues involved. And I think they're all factors that we will need to consider. I mean, you know, Ross has sort of drawn your attention to dates. We have looked at sort of, you know, as he said, the two core options are for a return to physical meetings are Toronto and New York. New York has attractions in terms of possibly, you know, one of the other factors may be accessibility in terms of frequency of flights going there. It is a space that's actually under IFAC's control. There are more screens there and so on. You know, probably the Wi-Fi is stronger. That's certainly been a bit of an issue in the past in some of the CPA meeting space. So there's quite a few different factors that we will, you know, we will need to bear in mind. But I think it's very good to get those comments in from members. And I think that's given some additional dimensions that we need to think about, you know, as we really, you know, keep a watch on the situation. And we will keep talking to you both at the board meetings and the check-ins in terms of how we're seeing things moving forwards. Okay, Ross, anything else then in terms of wrapping your report up?
No, just to highlight to members that I also talk about the additional staff and board resource time we have available in 2021 with the big chunk of consultations with ED 76 to 79 and ED 75 out. But I propose that we discuss those one by one in the next two items because that's what they relate to. So the IS 26 and the IFRS 8, IPSAS 18 projects. Okay, thanks, Ross. And I think that's quite a neat segue into the next two agenda items. And if members will bear with me, I just want to make a few comments before we get into the discussion on IS 26, because certainly in advance of the meeting, I think there were, I've heard quite a number of concerns expressed about IS 26 as a standard. In fact, it's old, the fact that there were options, inconsistencies and so on. And that made me think in terms of approaching the board meeting, well, you know, what is the reason for undertaking this as a project, other than just we might be able to squeeze one more in because of you know, availability of staff time.
And I suppose I sort of reflected on when I thought about it, I really kind of went back to my own experience in leading the implementation of the consolidated accounts for the public sector for the UK. That's led me to think that in making the decision, I think we need to think outside the kind of some of the technical concerns and think about this from a public interest perspective. And in particular, the role that this project could play really in shining a light on an area which I think around the world probably is quite murky and quite hidden in a number of governments, and therefore the fact that this could really contribute to delivering our overall objective of strengthening public financial management through the adoption of accrual-based IPSAS. Now, why do I say that? Well, if I think about what happened with whole of government accounts in the UK, this was the back end of a process in terms of moving to accrual across the public sector. And we had accrual accounts for our departments in the UK, but we hadn't actually consolidated them. So if you think about the pension situation, the real feature that we had, and obviously arrangements vary between jurisdictions, but the real feature we had was we had these big multi-employer schemes. So departments employed people, they made employer contributions to the schemes. And so in that respect, you know, if they were implementing the equivalent of IPSAS 39, well, they would be accounting for those and any sort of timing differences and so on. But the real issue was the big liabilities that we had for these schemes, because the big central schemes for the UK government are unfunded. You know, so you know, there are no investments sitting there to counterbalance the liabilities. And so we did, you know, in order to prepare a consolidated balance sheet, we needed information to bring those in. And I think one of the things that you know, the National Audit Office in the UK was very strong on was there should be no big figures that appeared in the consolidation that hadn't already been reported on, audited through an underlying account. So that meant we needed to prepare accounts for these pension schemes that forced the schemes themselves to get much better information on who the members were, what their entitlements were, and to actually make more regular valuations of those schemes. You know, and that process actually, I think, was very beneficial, you know, in terms of shining a light on what the extent of the liabilities was. Previously, it had been rather buried. There were no accounts for them. There was a kind of annual parliamentary question which picked up on some figures for some of it, but it was very much hidden away. You know, it also kind of forced some reforms. For example, we actually ended up with a whole properly configured pension scheme for our judges, you know, through the debate that hadn't been formally constituted before. It now has its own accounts, which show a liability of £5 billion on that pension scheme. And, you know, then when you put all of that together, you know, when you look at the UK government's balance sheet, which sadly is heavily negative, you know, the government has an overall pension liability of £1.9 trillion. Compare that with debt of maybe 1.4 billion in the last set of accounts. So you can see this is a really, you know, this is a really sort of significant number. And I think when you think about the fact that this isn't a direct requirement of statistical systems, you know, increasingly there is a requirement to prepare what they might call satellite accounts, but this isn't main information. It's really important that, you know, this is something that we could really contribute. And when you think about the sustainability challenges governments will have post-pandemic, and the need for strong balance sheets, which is something that I've been talking about, and I think increasingly the IMF and the World Bank have been very supportive of, that brings you back to the fact that this is significant and it's something that we should be moving forward with. And probably when you think about it, we've looked at some jurisdictions here, but those jurisdictions are the ones that actually have a relatively developed reporting framework. So, you know, we'll pick up on some of the initial findings from the update of the International Public Sector Financial Accountability Index later on in the week, but that shows broadly maybe a movement to about 60% of governments on accrual in 5 years, from 35% now, and then onwards maybe up to something like 80% by 2030. So, you know, there's going to be a big expansion in the usage of accrual and in the usage of IPSAS over that period. And I think that's where I come back to the thinking that actually this is a real transparency issue. This is a real issue in terms of public financial management. So better information for accountability and decision making, which is what we're about, I think would really be served by this project. Now, going back to IS26 for a minute, and I'll shut up in a minute, but I just thought it was useful just to put some context around this, which isn't in the brief and the papers at the moment. You know, certainly, yes, there are challenges in using IS26, and maybe we need to think about, you know, how we learn from the experience of those jurisdictions that have been preparing public sector accounts that do have private sector guidance, and you know, use that in maybe thinking about this as not so much an IS26 alignment project, but as IS26 adapted for the public sector and adapted in a way that's consistent with the rest of our literature and, you know, removes the choices and so on. And I think those are probably the thoughts that I came to just personally when I reflected and I took a step back, but I thought it was right and it was probably helpful to share those with the board up front. Now, I've got a couple of flags raised, so I'll take comments and then perhaps move over to Joe at that point. So Thomas, then Mike.
Yeah, thanks, Ian. I thought, kind of just having heard your introduction, I think it would be the right point in time to shortly share the discussion results of the CAG, because the CAG had a very short initial discussion on the mid-period work plan review, including IPSAS 18 or second reporting at IS26 pension plans in December. As I said, very high level and very initial, but I think there was already kind of a lot of the arguments also coming through, which you just shared with us, Ian. I think on one side, some hesitation regarding IS26 being kind of an old standard, having some problems in application. On the other side, clearly highlighting that IPSAS 39 is not helping for these types of pension plans because there are differences in the definition of a pension plan between IS26 and IPSAS 39, and others strongly advocating for there is a need for that in special jurisdictions there, especially in South America. There was a special need for applying these types of standards to kind of a UN pension fund. And therefore, I think the CAG had clarity on, yes, it's only a few entities which might be impacted, but it is material numbers in terms of kind of the whole of government accounts and the effect on that in terms of transparency. And so overall, I think I would say, yes, some hesitations regarding is it really kind of, is it kind of a good starting point, let's say it like that, for adapting, but yes, there's a need. I think this is what the CAG came out at the end.
Thanks, Thomas. And I think it's interesting that observation about it might be a smaller number of entities, but the numbers involved are very significant, actually. Mike, and then we'll go to Joe. And the first slide that Joe has just is to you know, make sure we're all on the same page in terms of the understanding of the sort of situation with these multi-employer schemes and why there's a gap. Mike.
So thank you. And I think your reference to the public interest was very helpful, and I'm glad you've done that. I would just add for members who haven't been around a while, I suppose that's a problem when you've been around too long. But when we had our various national standards set of forums starting back, you know, 5 years ago now, and the session at Winterthur, there was a very strong push by our constituents for a standard dealing with this issue. So IS26 may or may not be the best one to be trying to start with, but it's what there is, and there is a demand for the standard. And I think I was still trying to support Ross, because I think there is a need for him to make sure his staff have got things to do. So I'm supportive of the concept of what we're going to talk about in a moment. I've got some points of detail, but I suppose I'm keen to at least support your point about the public interest.
Thanks, Mike. Okay, so I think that you know, probably at this stage, Joe, we've taken up quite a lot of airtime already, but if you can sort of move us into the introduction to the item, and then we'll walk through it and sort of pick up the discussion, having set some context. So, Joe,
okay.
over to you.
Thanks, Joe. I'll just share my screen. Okay, so as you're aware, we're on agenda item 3, accounting and reporting for retirement benefit plans. So the objective of this session is to approve a project brief and add this project to the work program. It's not on the work program at the moment, so that would be very helpful. This project was included in the 2019-2023 strategy and work program as a Theme B alignment project to undertake when there was staff resources. And as Ian has said, we now consider it's now more of an adaptation rather than an alignment project. And that said, depending on how much adapting needs doing, we do still think it could be a relatively short project. The timeline that we initially proposed was to have an exposure draft issued in October of this year, and then an IPSAS in October of next year. IPSAS 26, sorry, IAS 26 in itself is a very short standard. It's only 37 paragraphs, but obviously we need to have a look at what needed to be adapted to have the requirements of IAS 26 fit into the IPSAS framework. I'm just going to move along, and I've got a short sort of cartoon on how an overview of a retirement benefit plan. So you have an employer or multiple employees, and obviously those employers have, you have employers and they have employees. Now, maybe sometimes a part of a salary package is the employer will provide a pension scheme for the employees, and they will provide contributions to a retirement benefit entity. So they will make contributions into that entity for those employees. Also, employees may make their own contributions. These contributions may be voluntary, or they may be a requirement of the employer's scheme. So there may be a condition that the employer sets that if they say, we will contribute 10% of your salary into the retirement benefit plan, you will need to contribute 5% of your salary. Now, why do employers provide pension schemes for the employees? Well, it's so that when the employees actually retire, they have an income to live on. From a financial standards perspective, the employer will prepare their financial statements under the full suite of IPSAS. We're assuming they're an IPSAS adopter. Now, many employers will pay into a multi-plan scheme, multi-employer scheme. So there might be one retirement benefit plan that many employers pay into. The employer will prepare their financial statements and they will use IPSAS 39, employee benefits, to show their obligation to the retirement benefit plan for their employees. If those employers pay into a multi-employer plan, then often they will recognise their obligation for contributions on a defined contribution basis, whereas they may be providing a defined benefit pension to employees. So there is a significant difference there about the level of the obligation that they would recognise in their financial statements. So if they're only recognising a defined contribution obligation in the financial statements using IPSAS 39, the actual obligation for the pensions could be considerably higher. These defined benefits are often based on final salaries, that perhaps when the employee retires, their pension is based on an average of their their last 5 years' salary. So that could be a significant difference. From the retirement benefit entity perspective, they will also produce financial statements for the operations of the entity, so the assets, the expenses, the liabilities that they incur for administering the retirement benefit plan. What IAS 26 is interested in is actually providing requirements for the retirement benefit entity to prepare financial statements only on the plan. We're not talking about the operations of the entity that administer the plan. We're just talking about the financial statements of the plan. And why are these statements important? Well, it's so that the employers and the employees can assess whether the retirement benefit plan actually has the plan assets that will fund the employee's future pension obligations. As there at the moment, there's a gap in the literature, as we've mentioned. So looking at the two different types of statements from the employer and the retirement benefit plan, if an employer is reporting on a defined contribution basis, the retirement benefit plan will need to report, if they are providing a defined benefit pension, they will need to report the obligation to the employees based on a defined benefit calculation. So it could be considerably higher than what's reported from the IAS 39.
Okay, thanks for that introduction. Perhaps you can take the slide down for a moment and we'll just see whether members have questions about that introduction, because I think it's quite important that we all understand the landscape before we get into the detailed discussions. So just pause and check whether anybody wants to clarify understanding. Mike.
So thank you, Joe, and that's pretty much what we do where I come from. The one thing I would add, though, is that where the entity that's preparing the retirement benefit entity has a significant shortfall in or an unfunded component of a defined benefit liability, that amount is picked up in the whole of state accounts. So we don't consolidate that entity, but we do pick up the shortfall, and that could be a significant number, as you said.
Thanks, Mike. That's very helpful to point that out. And certainly the same is true in the UK. Anybody else? Questions, comments? Okay, fine.
Okay. Moving along.
Back to you, Joe.
Okay. So we're going to move, just moving on to agenda item 3.2.1. And we undertook limited research. We're just interested to see which entities were using IAS 26 and in what capacity. So this is just really briefly. So for entities that use jurisdictions that use IAS 26 with no changes, firstly, we've got the United Nations. The United Nations is an IPSAS adopter, and at the moment they are using IAS 26 via the hierarchy in IPSAS 3. We also found that the pension fund for the CERN, which is the Hadron Collider in Europe, they also are an IPSAS adopter, and they are using IAS 26 without any changes. Jurisdictions that use IAS 26 but they have amended the requirements include the United Kingdom. So this is the government of the United Kingdom. So the government financial reporting manual, they are an IFRS adopter, and they are using IAS 26 amended for their government pension funds. We've also got New Zealand uses IAS 26, but I will stress that this is only for the private sector. No, they do not have an equivalent public sector accounting standard for IAS 26. Jurisdictions that use IAS 26 by analogy, we've been informed that South Africa uses IAS 26 by analogy, and what I mean by that is that in South Africa, it is the pensions regulator that sets the requirements for pension retirement benefit plans to report under, but they use the requirements in IAS 26 to actually set what those how those retirement benefit plans will report. Jurisdictions that are non-adopters of IAS 26 include the European Commission. Now, European Commission is an IPSAS adopter, and they have what is called a notional virtual fund, where there's no investment made, but member states will guarantee the payment of the pension liability. The only pension liability, the pension liability that they show in the accounts is the IPSAS 39 obligation. We've also got Canada. Canada is an IFRS adopter. They did actually adopt IAS 26, however, and it is in the CPA Canada handbook. However, the preface to the handbook prohibits the use of IAS 26, and retirement benefit plans within Canada must use section 4600 of the handbook, which is a jurisdictionally specific standard for retirement benefit plans. And finally, we have Australia. When Australia is also an IFRS adopter, when Australia moved to IFRS in 2004, they already had a domestic standard for retirement benefit plans, which was AAS 25, and they have since revised that standard and issued AASB 1056 superannuation plans. And again, that is a jurisdictionally specific plan, and it is written in conjunction with the pensions regulator within Australia.
Thanks, Jo. So I think at that stage we might just pause if any of the members from the jurisdictions covered want to add anything, or if members from any of the jurisdictions not covered in those examples have anything that they want to add, just in terms of how their jurisdiction addresses these things. Yeah, I have Nima, then Todd.
Thank you very much, Ian. We have used IAS 26 for pension funds, which are owned by the government, and the government is in full compliance with IPSAS. So these pension funds have done actuarial evaluation in line with IAS number 26. And what we noted earlier on consolidation and the IPSAS was the argument from users that the government is paying pension, but because on consolidation, we have the government entities, pensioners, some of the pensioners are employees of the government. And as a result, pensioners paid to government employees, the argument was that it should not be treated as retirement benefit. Rather, it is more of an employee benefit and should go to IPSAS 39, then IPSAS 25. So it was a long debate, and the government then decided to split the pension funds into one pension fund being owned by the government and one pension fund for government employees and another one for private sector employees last year. And therefore now they're saying that because on consolidation, the government becomes one thing and all the government under the government will be consolidated, if there will be pension, which will go to government entities employees, probably that should be classified under IPSAS 39, and pension which will be paid to third parties, private sector, that is what should be treated as IAS number 26. So probably I've seen that as one of the challenge, and maybe that one we can consider if it makes, if it is of any importance in setting our own standard. I think that will be very useful. Thank you, Ian.
Thanks, Nima, and I think that's very interesting to hear from a direct IPSAS adopter there, that debate that's been provoked by the developments in financial reporting. Todd, over to you next.
Thanks, Ian. I just wanted to mention in respect of the New Zealand position that it was certainly quite a controversial decision at the time, because the New Zealand standards ahead of adopting IFRS, there was a standard for retirement benefit plans, and I think it's fair to say that a lot of people thought that we had a better standard than IAS 26, so it was quite controversial. And another couple of comments. We did do some work with the national standard setters in the for-profit space and looking to recommend the withdrawal of IAS 26 to the IASB. And we also took a number of matters to the IFRIC because we felt that there was different practices as a result of adopting IAS 26. Unfortunately, IFRIC didn't take those onto the agenda, but you know, I just wanted to paint a picture that this wasn't sort of an easy decision and a slam dunk, and IAS 26 is all fine, which is why I think, you know, we have to be proceeding cautiously in terms of using IAS 26. In my view, it's a 33-year-old standard, and I think it's important that we make the appropriate changes as we proceed with this project.
Thanks, Todd. And I think that learning experience is, you know, is going to be or would be incredibly important if we proceed with this project, that we can draw those experiences in. Okay, Renee, you want to come in?
Yes, thank you, everyone. Thank you, Chair. So yes, so in Canada, our pension accounting standard had been in place for quite a long time before we adopted IFRS back in 2011. It was considered clearly a superior standard to IAS 26. So I'm personally very supportive of an adaptation approach as opposed to a conversions approach. Also, it's interesting what Nima describes as the two potential scenarios. For us, the scope of our standard includes pension plans, but it also includes other types of plans that are managing similar programs or similar obligations. So the standard is about the plan's activities, irrespective of whether it is an employee benefit plan of a government, of a sponsoring government, or another benefit, another scheme that could be, for instance, in our own standard, the example given could be health benefit, long-term disability benefit. So in our jurisdictions, some of these benefits are also organized as independent entity, independent plans where the assets and the obligations are managed. When it comes to the pension plans that are managing employee benefits, we have a very interesting and actually very useful, when I talk to our counterparts who are using it in our jurisdictions, there's a useful reference. It's like an expedient when it's an entity managing a pension plan to actually look to the sponsor's own pension valuation and to use it, really, as opposed to having to recompute another one. And that really helps with consistency because the plan is managing the sponsor's pension obligations. So in terms of using actuarial expertise and actuarial efforts, it's very efficient, and it's also very useful to remove confusion when we're talking about the two entities presenting the same obligation from two different perspectives. So looking to IPSAS 39, I think, yes, IPSAS 39 as a way to expedite the measurement of the obligation. This is something that could be interesting to consider here in this context.
Thanks, Renee. And of course, it's good to adopt the international strategy that, or to recognise the international strategy that was adopted in Canada, which will mean that the Canadian public sector increasingly takes account of IPSAS in its go-forward standard setting activities. So thanks for that. Lynn.
Thanks, Ian. And you might want to return to my comment when we get to the project brief, but just hearing the presentation, reading the paper, hearing the comments, it's clear, isn't it, that where IAS 26 has been adopted, it's been heavily adapted or interpreted for the public sector. And yet our project brief is still calling this an alignment project. I think we ought to be really crisp and careful in how we describe this, because if we were doing a narrow straight alignment project, the answer won't be fit for purpose for the public sector. So I think we ought to really think carefully about how we describe what we are doing, and we can return to that comment in the project brief. So I am supportive of a project, but I think we need to think about what and how we describe the project, because we don't want to get to a later phase and then say, oh, well, we're not going to do this and this useful thing for the public sector because it's just an alignment project. So I think we need to be clearer at the front what our objective for the project is. And for me, I don't think it's a straight alignment project we're talking here.
Thanks, Lynn. I think that's very helpful to make that comment. And yes, we'll pick that up. You know, we'll come in a moment to just coming to a view on, you know, formally whether we proceed with this. But I think if we do, then not only in the project brief, but also in the communications that we have, and as you say, in our ongoing work, that lens of this is an adaptation rather than alignment would be very important. Okay, so Mari, you want to come in?
Thank you, Chair. In Japanese scene, we have a multi-employer plan, and at that case, the privatization has been progressed. So the constituent of the multi-employer plan is a privatized organization and its former supervised ministry, and so in such case, how we can consider about the alignment of the IPSAS and IAS, and so it's my point of view. Thank you.
Thanks, Mari. And I think that, you know, that's one of the challenges we always face, is being clear about where we have used IFRS is, you know, as the start point. You know, being clear about the reasons why we're making adaptations or changes in terminology as a minimum and so on, so that you can, if it's a private sector organisation, if you've got the consolidation situation across the public sector, you don't get those mixed group issues arising. So we're clear on how we've used guidance and why, and so on. Okay, so Joe, I think move us on to the next item, which is really just taking a formal decision on whether we proceed with the project or not.
Oh, you wanted to skip ahead to that one, did you? So we did have a few more papers to go through, but
so we've got there
was the why develop the pension, the standard, but I think we've covered that.
Yeah, I think it would be helpful at this stage just to get a sense of, you know, members' willingness to go ahead with the project, because then I think we'll start to discuss, if we do that, then some of the issues. So I think we kind of have covered 3.2.2 as a paper. Is there anything else you want to draw out on that before we then so just take a straw poll on whether we're content to move ahead?
No, I think if you just want to go ahead and just find out, like there was the paper on the potential issues, but I think, you know, there may be more issues that need to come up from that. And these issues are in the project brief, so if we want to go straight ahead to that, we can certainly do that.
Yeah. Adrian, did you want to come in quickly?
Yes. Yes, sorry, and I couldn't find the right hand on my screen.
I did see it actually briefly for you, so you obviously hit the right button anyway. Go ahead.
No, I found it with the help of Leah. Yes, I just wanted to make a very, very short comment on the introduction. The presentation shows a sort of a broad picture of the users of IAS users as it is or adapted. Well, if you understand that, as I told you, now the CERN is not member of the European Union. It shows that nobody in the European Union ever tried to use IAS 26. not because they don't believe it's a good standard, but because they have very different ways of handling their pension schemes, the public pension schemes. Well, exactly in the way that Joanna shows on the diagram. We don't have, in Europe, there's very little cases where I would say states delegate to a legal entity the distribution of benefits. So it makes a very big difference between what I would call, sorry to say that in this way, the Anglo-Saxon world, including the UN. If I may say, for the UN, the only issue is with the UN Joint Pension Fund, because a lot of agencies or other entities that are coordinated in the UN system have their own pension funds, which they delegate to private entity or which they sort of consolidate in their financial statements. So, and again, sorry for putting the question this way. It might sound blunt, but it's one of a newcomer. The question is, referring to question 1, should IPSAS board develop a new IPSAS? Is it worth developing a new full IPSAS from the IPSAS 26 for the number of users that we see in the description in the presentation that was made by Joanna? Maybe there are other users, but we don't really know, maybe in Asia or with those that have adopted IFRS in other constituents.
So I think on that, Adrian, I think if you like, this is only a very partial survey at the moment, and I think probably the answer is actually it's a bit like the proverbial iceberg at the moment, and that you see a very small amount of this issue showing above the surface, but probably there are a whole variety of arrangements out there which are not being reported on regularly at the moment. So almost the reason for doing this project is for that large number of jurisdictions around the world and types of organisation that don't have guidance on this, and therefore the problem is probably in the background and not acknowledged. And that probably is the reason for actually doing this, is actually shining a light on those liabilities, because they are liabilities to former employees from the pension arrangements. And yes, there is an uncertainty, but I think there's no doubt there is a problem around the world with this issue.
Just a follow-up?
Yeah.
Yes. But then, wouldn't it be more expedient to just copy-paste IS-26? Because in many instances that were described by Joanna in the jurisdiction that currently uses the IS-26, well, I would say that they use IS-26 as it is. So, okay, just copy paste and ask the jurisdictions if they're happy with the copy paste of IS-26. Well, sorry, it's a bit naive probably, but you will have to excuse that from a newcomer for some days.
No, it's fine, and I think we will have a discussion on that. I want to just take the remaining comments on this in terms of whether we should proceed, and then we'll look at that question as to what the precise nature of this would be and adaptation. So I've got Bernard, Kamira, and Lindy.
Thanks, Ian. Actually, I have a question to staff. So given the debate, I think it was really interesting to get a lot of comments on whether it's tailored enough to the public sector or whether it's an alignment or an adoption element. I just wanted to check with staff actually on the resource estimate that they have in the paper. Do they feel different now hearing the debate, or is it about the same estimate from the current state?
Ross, did you want to come back on that?
Yeah, so I guess I'd have to say on the resource estimate, we'd have to look at the extent of adaptation that we're thinking about. But even in the project brief, we didn't want to get into what the issues would be in terms of what we might take away. But our thinking very much was, when developing the project brief, that we'd look at the various options that are in the standard and remove those options that are less aligned with IPSAS, and try and, in our alignment, I think we were always thinking of it as adapt the standard to work better in the public sector. It is an old standard and it has been criticized in the past, but there are options within the standard that if you select that, are along the lines of giving us the information we want. So I think we're still looking at an adaptation in removing options and, not necessarily making this a mini project or a major project. It's based on IS 26. How do we adapt that standard to make it work for our constituents in the public sector? And we think there are some ways to do that. So we have IPSAS 39, which is the pension accounting standard. So we could make a link from IS 26 to IPSAS 39 and say, if you're presenting retirement benefits that are employee benefits, you use IPSAS 39 to measure those. There are some, we think, a few low-hanging fruits we could take on that, but we would have to be careful if we want to meet the very strict resource requirements we have, that we don't get too ambitious with what we're trying to do to fix this problem. So I guess I'd say it depends on how wide we take adaptation.
Thanks for the clarification.
Okay, thanks. So I've got Camira, then Lindy, then Mike, then Ajith, then Mark. So Camira, to you first.
Thank you, Chair. Well, I just had a couple of comments after listening to the interesting discussion. I just thought that, I remember even in the case of Panama, there are also, we have this Ministry of National Security and Safety where they also have like a separate retirement benefit plan for police, which is totally separate from the government social security funds, which these kind of institutions, maybe not only Panama, but other countries could also apply this standard. So I really personally, I feel it's a relevant standard to develop and also to close a gap in the literature. And I had only two small clarification questions for the staff. One of it is if this new standard would apply also for these virtual funds that are mentioned in the paper. For in the case of again with the Ministry of National Security and Safety, they do have contributions and they assume the full liability, but it is a virtual fund because actually there is no separate bank account within all the funds are like merged with the Treasury single account. So I would like to know if this new standard would apply in those cases. And the other clarification question is just like out of curiosity, I took a look at the IS 26 and there is a scope exclusion for government social security schemes. I would like to know if that exclusion in ISB was only just to don't be to the scope of IPSASB, or if it was, what was the reason for that scope exclusion on IS 26. So thank you.
Okay, thanks, Camira. So if we can come back to the scope question in the next section of the discussion, I think that is going to be, I think the comments we've had already from members show that's going to be quite an important issue, how we address that. So I've got Lindy, Mike, then Ajith and Mark.
So I do think what would be important as a starting point in the project brief is to emphasize that we've identified that there are reporting entities in that exist, and maybe there aren't as many reporting entities, but characteristics of reporting entities in the framework. But there is significant resources or obligations within them that users would rely on information to be provided by them, and that's why we're dealing with the projects. I wouldn't do so much around, well, what do other reporting entities do in the public sector, and they use defined contribution accounting. I think it is about the fact that there are reporting entities that should be preparing general purpose financial statements, and we are undertaking a project to give them guidance on how they would do that. And that is the gap in the literature. I do think that we do have IPSAS 39, and we should lend from that in terms of the measurement of the assets and liabilities. And I also do think there are useful disclosures in IAS 26 that looks at, if I am the reporting entity, what information should I provide my users? And it might look differently to IPSAS 39 type of information, because we're looking at it from a report. I think we need to come up quite strongly that there's a reporting entity dealing with them, what they need to present, what specific disclosures they would require, and specifically how that information will be presented, useful for thereof. I think that might help with the justification, and then we would just have a look at, well, where we would align with our literature of the assets and liability.
Okay, thanks, Cindy. You were cutting out a little bit there, but I think that was some very useful points in terms of how we address that. So I'll go to Mike, then Ajith, then Mark. And then what I want to do is then just move us to a show of hands in terms of whether we're moving ahead with this project as an IAS 26 adapted. Okay,
Thank you.
So go to Mike and then Ajith and Mark.
Thank you. And so I support doing the project, mainly for the public interest reasons that you outlined at the start. But it's going to be subject to, I think, agreeing on what the issues were, which is in agenda item 3.2.3. And then having looked at those issues, if those are the right ones, are there any more? Not sure, agreeing on what they are, and then coming back to the resources and timing. So as long as we can agree on what are the adaptation issues that we need to deal with, then I can sit back and say, well, yeah, it can be done or it can't be done. I hope it can, because I think it should be done.
Okay, thanks, Mike. And agree, we need to collect those issues. We won't be exhaustive, I think, in the project brief, but as long as we can get the main ones, and then I think we will ask staff just to go away and reflect on the timeline. Okay, so I've got Ajith, then Mark.
Thanks, Ian. I think adopting IAS 26 is very useful, and I think it's important because the large sums of money involved in relation to retirement benefits. So that is a substantial amount of public funds that are reflected in the financial statements, and therefore, the public needs to know what is it's about. So I think there's a heavy public sector interest in relation to this project. So I think I would support adopting IAS 26. While doing that, I think I'm in support of the staff's idea that we should remove the optionality of most of these items that are given in IAS 26 and make it more in line with IPSAS standards based on other conceptual framework. The another aspect that we'll have to keep in mind is that IAS 26, the drafting style, is a very old drafting style. And we may need to adapt it to modern drafting style because the drafting style is very old. You see that some of the requirements are specified as if it is a practice and not as a requirement. It doesn't say you shall do it, or it says that this is what happens. So that style should need to change. And also some of the reasoning that goes on is included in the standard itself, whereas it should have been in the basis of conclusions. So that kind of changes will need to come in the drafting stage of the standard. So having said that, I think I would support the adoption of the IAS 26 standard. Thank you.
Thanks, Ajith. So Mark, final comment from you, and then I'll ask for a show of hands in terms of moving forward.
I agree that we're taking this project forward because it obviously seems to be a gap for some jurisdictions with high amounts. Just on the way forward, to have the question whether we should have an extended project with adaptation, and depending on what really this means for the resources, I also would like to highlight that we should look at it also in terms of the other projects in the midterm consultation, because obviously if it has an impact on the resources of these projects, because we now need more resources, I think we should, to be fair, also apply the project prioritization criteria then if it's too big project. However, if staff have the feeling, okay, it's an adapted version, but it's still, the resources are still available and are not a threat to the resources for the mid period, then I can say it's fine, we can move on.
Okay, thanks, Mark. So on the understanding, and I think this picks up very much on what you said, Mark, on the understanding that this remains a limited scope project, notwithstanding what we've talked about, and the fact that we will need to come back for a staff confirmation, I think, Ross, once we've collected the issues that need to be addressed, to see if that significantly changes that, if you like, view. Can I ask for a show of hands in terms of members that would support going forward with a limited scope project adapting IS 26 for the public sector context? So if I can ask for a show of hands in favour. Okay. Anybody against proceeding with a project? So if you could take your hands down, and then we'll just ask if anybody's against that. I'm not seeing anybody against. Okay, so I think on that basis, we are moving ahead with a project based on IS 26, but adapted for the public sector. So what I'm going to propose is that we take a break at that point in time, and then we will come back and we will look at the list of areas that we think an adaptation will be needed in. Now, those will, the significant issues will be, and the context for our discussions already will need to be reflected in the project brief. So we won't vote on the project brief today. Instead, I want to have the next stage of the discussion to collect those issues that aren't already mentioned. And then we will ask staff to make appropriate amendments to the project brief, and with a view to that being brought back for a vote on the Tuesday session on the 23rd next week, if that's okay as a way forward. So that would allow us to collect the issues, it would allow us to firm up on the project brief, and it would also allow staff to consider the point that Mark raised in terms of, do the additional adaptations that we collect, do they mean that it can't be taken forward in the sort of slot that was originally envisaged? Okay, so with that, we take a break until 22. And as ever, David, my TA, will keep a watch on time, and he will tell us loudly a minute beforehand when you're due back. So go and get a coffee or whatever beverage you would like, and see you back here in about 10 minutes.
1 minute warning.
Okay, thank you, David, for timekeeping. So we'll just wait for a few more members to come back on screen. Okay, so what I want to do now is, recognising that we won't move to a vote on the project brief, that staff will need to update the project brief for members' discussions on how, on the key area, on the context and the approach we'll take on this project. Joe, if you can move us into the discussion about the key areas we will need to consider in adapting IS26 for the public sector. And really, I want to pick up areas at this stage. I don't want to get into debates on how we address those. This is collecting issues so that we can get the project brief reasonably complete. And also, we don't need absolutely all the issues in detail at this stage. Key issues, please. So, Joe, if you start with that.
So the areas that we had already identified were the 3 areas that are included in the project brief that we know we will need to address. They all concern the optionality that is within IS26, and these are the measurement of the actuarial present value of promised retirement benefits, the valuation of the plan assets, and presentation of actuarial present value of promised retirement benefits. I think we'll also need to consider the scope of the project, given the comments that we've had already. But I'm just interested in any other areas that the board is interested in. I was quite interested in Aj's comment about the style of IS26, because there is, when I was reading through it, there is a lot of text in there that when I was reading it, I was thinking, well, actually this sounds like application guidance. So whether the board wants to go to that extent of rejigging the standard to make it further more in line with our current style, I'd be interested to see if the board is interested, would like for us to attempt that. But yeah, any other areas that we need to include in the project brief, and then we can then take that away and decide what effect it's going to have on the timeline.
Okay, thanks, Joe. So in terms of this, I think we take it as read, and this will need to be covered at least at a high level in the project brief, that we will be making those sort of changes that you've identified due to the age, that it will need to be updated in terms of style and content. In doing that, though, I think we need to be very clear about what is going where and why we are making changes. So it's not just rewriting the standard, it's using the material in the relevant context. So that, I think, is a is one of the disciplines we need to use. So you coming out of the discussions earlier, you picked up on scope, and how we describe the scope is going to be very important for addressing the sorts of practical issues that, for example, Camira raised and other members raised. So other issues that members feel will need to be picked up. Yes, David.
Thanks, Ian. I was thinking about it, and of course, I suppose coming from a UK perspective and having been involved with the pension reporting, I think picking up on your point about what's in the public interest, I think when we're thinking about presentation, we need to think about, and picking up on Lindy's point as well, we need to think about what sort of information ought to be presented in general purpose financial statements, as well as general purpose financial reports. Which may mean that IAS 26 is adapted quite significantly to pick up on the requirement for other statements.
Okay, thanks, David. So I'm just going to collect comments at this stage and then back to Joe afterwards. So I go to Mike and then Todd.
Thank you, Chair. So thanks, Joe. I just wondered if in your page on 3.2.2, where you talk about gaps in literature dealing with contributions, not as revenue, but as something else needs to be dealt with. We need to at least flag that as an issue. We dealt with that in Australia, but I just want to make sure it isn't forgotten. The other thing for me was consistency with the conceptual framework. Do we need to flag that this, whatever we come up may or may not be in line with the conceptual framework? I don't mind as long as we've identified it. And then I'm not familiar with, I'm afraid, IAS 26. I don't know what the disclosure requirements are. Is there a need for us to make sure disclosure is consistent with what our other standards are doing? Thanks, Chair.
Okay, thanks, Mike. I think that's right. You know, certainly I heard that coming out of comments from members. Consistency with our other literature is going to be really important here. Use of those principles. I think Lindy picked up on that, for example, in her intervention earlier. Okay, I'll go to Todd and then Renee.
Thanks, Ian. And I think staff have been provided quite a lot of comments from New Zealand. And they probably fall under two broad headings. And thank you, Joe, for mentioning the scope. And I think scope definitions do need some work. But the other broad area is really the interplay of having a new IPSAS in this area with all of the other existing IPSAS. And I think this is one area where it's quite unclear in the IFRS world how IAS 26 works with all of the other standards in the IASB's suite. And I think it's really important that we actually think that through and make sure that we are clear how this works with all of the other standards. You know, just as an example, if you are applying the IPSAS that we're looking to create, what is it that you're asserting compliance with? Is it just that IPSAS, or is it you are complying with the IPSAS suite of standards? So I think there is a bit of thinking and work to do in that space, just in terms of how this works with the rest of the standards. And you know, the comments that we've already provided through to staff will pick off a number of things to think about in that regard.
Okay, thanks, Todd. So go to Renee and then Lucy.
Okay, so on scope, so I think, Joanna, you probably already noted the comment I made about other similar arrangements and maybe a way to bring that in addition to pension arrangements. The other difference that we have in our Canadian standard in scope versus IAS 26, IAS 26 refers to benefits provided to employees on or after their term of service, whereas an employee benefit is also provided during the active service. So that it seems like a small nuance, but I think it's an important one. It's one that's been made in the Canadian standards. Just wanted to put it out there for you under scope. Also under measurement of the pension obligation, I think we mentioned it and you noted it, Joanna, the idea of potentially looking to IPSASB 39 when it is a pension obligation, of course. And also a third one, Joanna, I've been reflecting on one of the comments you made at the beginning in your presentation when you made the distinction between the entity's two sets of statements, and you kind of put on the right side of your slide those other activities that may be generating other liabilities or other assets or other liabilities that are more as a result of operating the plan or managing the plan. I think in Canada, this is all part of the same financial statement of the entity, especially if these operational costs are deducted from what's available as net assets being available to the beneficiaries. So maybe we should look at that as well. Thank you.
Okay, thanks, Renee. Some good points there. So I'll go to Lucy and Lynn. So Lucy first.
Yes, thank you, Chair. I don't know if we can still also cover the accounting treatment in the recognition of the members' contributions to those retirement plans. We made a comparative analysis of the retirement benefit plans that are maintained by 3 different government agencies in the Philippines, and we noted that they have differing accounting treatment for the recognition of the members' contributions. 2 of those 3 that we have analyzed recognize this as income, and the other one recognizes it as equity. But of course, when we look at their governing laws, it seems that they are, they are consistent with the relevant requirements provided under relevant government laws. But since these are both retirement plans, I think there is a need for us to also harmonize the recognition of the members' contribution, whether this could be income or equity, or there should be some reserves that should be considered by the government agencies that are maintaining these retirement plans. Thank you.
Thank you, Lucy. So Lynn, over to you.
Thanks, Ian. I was just reflecting on some of the comments that were made, particularly David and Renee, but also the general conversation. I guess the 2 points for me are the earlier paper where it discussed what different jurisdictions have done to adapt the standard for use in the public sector probably contained more of a list of issues than 3.2.3 does. So picking up on David's point around what is a set of general purpose financial statements, just to pick one example, both the UK and New Zealand require a statement of cash flows, just one really small example, but that's not included as an issue in 3.2.3. So I think it is worth revisiting all of the areas that those who have adapted for the public sector. There is your list of potential issues, and I would sort of take those and plug those in as potential issues. And I don't think we've done that consistently. So you can see the UK have done a lot of extra requirements, and I think you ought to think about those. Maybe we're over the top, maybe we've done too many, but it's a good list of issues as a starting point. And then my second point is I do wonder if a potential issue that's not covered is clarity on what the reporting entity is. Just reflecting on the sort of discussions and what is a retirement benefit plan, and are we clear on the reporting entity? I do wonder if we ought to give that more thought, because I think that without clarity on that, what things are included in scope or aren't could be not very clear to people. I think we know, but we're probably all thinking about that from our own jurisdiction, and I'm not sure that we are thinking about that consistently.
Yeah, thanks. And that point in terms of reporting entities, very consistent with the point that Lindy was making earlier on about the way into this. And I think your point about actually we're going to need to have a conversation about this, because that debate will focus us. And I think that goes to Renee's point as well in terms of, are you talking about just the plan assets and liabilities, or are you talking about, how you account for the operational costs and so on, so yeah, I think that's a very helpful point. Mike.
Yeah, thanks, Stu. Just to add to that, don't forget local governments. So in my jurisdiction, local government have got some quite rich pension schemes, and there they're reported at the local government entity level, whereas at my sort of whole of government level, that may not be the same.
Yeah, I mean, I think that's where we've got to frame this in a way that sets the principles, haven't we? Because as you say, it can be, the idea is the standard could be applied at different levels, but then obviously you get different structures in terms of the way the public sector works. And I know the UK approach is very atypical in terms of consolidation of municipalities. That virtually nobody else does. So, but the principles should still be capable of being applied. Okay, so I think that's been a useful discussion then, Joe, in terms of, I think, Lynn's point in particular of go back to the analysis earlier and make sure where we've got the experience from other jurisdictions that we pick those up as issues that we need to address in terms of the, the list of issues at this stage. Obviously, so we've got reporting entity scope. I think the interplay with our other guidance, in particular IPSAS 39, has come through very strongly. There's also Lucy's point on member contributions as well. So I think in terms of taking those forward, if you can update the project brief for the discussions on context that we've had already today, and then if you can pick up those additional issues, obviously that's not exhaustive at this stage, but that should then give us a more rounded project brief for review on Tuesday. Lucy.
I would just like to also suggest that we might also, there might be a need also to consider, among other issues, the budgetary concerns of the respective jurisdictions in developing an IPSAS that's aligned with IAS 26, especially the employer share, because in our case, for instance, aside from the members' contribution, there is an equivalent percentage also that is being shouldered by the employers, certain percentage of the contribution that is also shouldered by the agency. So this should also have some impact on the availability of the funds or allotments or appropriations for that purpose. Thank you.
Yeah, I think, Lucy, that probably reflects the tension we're going to have to address, which is that we can't get into the actuarial issues around calculation of rates and so on. What we need to do is focus on the reporting of the decisions that have actually been made. What's done with the information is outside our remit, but I think we can report how those have been, on how those have been set, what the consequences is, rather than actually get into that process and the actuarial side. So David, and then I'll take a final comment from Lindy, and then I'm going to wrap this up because we need to move on to the other discussion, or the next discussion on IFRS 8. David, then Lindy.
Thanks, Joe. It's just a quick question. It's probably too small a project for a task force, but is there going to be a board sponsor?
I think that's we'll come back to you on that, but that needs to be decided. Yeah. Lindy, to you.
Thank you. I was also just wondering if it would be important to have a clear statement around what this project is not going to do. So just in preparing for this meeting and looking around at what jurisdictions have been doing and in a couple of research papers, I think there was a strong push at one point in Europe to relook at how defined contribution plans should be measured and whether there should be actuarial valuations on those as well. Maybe we should also say that that's not the monkey we're going to take on. Just conscious of, questions that come up when we do projects, or whether we're going to address other type of concerns that have been raised previously. So we're not going to change the fundamental way in which these things will be measured. We're going to align it to our existing literature so that we don't start getting comments around, we don't like the way defined contribution schemes are being accounted for, etc.
Yeah, okay. Thanks, Lindy. Joe, you're clear on the additional issues that need to be added into the project brief?
Yes, so the list that I've got is we're going to clarify the scope, and is it going to include other benefits like Renee had mentioned? We're looking at, is it a GP, general purpose financial reports? What sort of statements do we need? Do we need to add? So at the moment, we've only got the two statements that IAS 26 has. Do we need to add in another statement like statement of cash flows? How are we going to recognise contributions? Sorry. So are contributions revenue? Clarity on what the reporting entity is. We need to have a look at the interplay with IPSAS 39 and with all our other literature, and look at the style, whether we're going to change the style, not necessarily vastly change the content, not a complete rewrite, but are we just going to move things around and maybe put stuff in application guidance basis for conclusions type thing to make it a bit more updated.
Thanks, Joe. Yeah, I think on that last point, we just need to be careful not to make change for change's sake.
Yeah.
So it's incremental change rather than a complete rewrite. Todd, I'll take a final comment from you. Then I just want to go back to you, Ross, from a staff point of view, and then we'll wrap up on this item.
Thanks, Ian. It was helpful for Joe to go back through that list. I think the one thing that was missing that I think is quite important was the point that Lynn raised in terms of we just need to do a check against the likes of the UK, New Zealand, some of these jurisdictions to see whether there's anything that we've missed through this discussion. And I think it is important that that is done in case some of the things that are sitting in there haven't been raised through this discussion.
Thanks, Todd. I think that's right. That's very much a sort of catch-all, if you like, but it does reflect, I think we need to take as much learning as possible from those jurisdictions that have been working with this and the challenges they've found. Ross, anything from your end? I think probably we need to reflect on that point that was made in terms of, are we going to have a task force on this one or not? And that's probably something to come back with when we bring back the project brief.
Yeah, I think, Ian, we will have to consider that. In the project brief, we had proposed a board member sponsor. That might still be appropriate, but I think we need to take away these issues and think about it. I think another thing we need to make sure we do from a staff perspective is at the moment we're collecting a long list of issues, but in stepping back and looking at them, I think we have to prioritize those that are significant and major versus, other minor issues, and how we're going to approach between the two. Because I mean, from the staff and board perspective, we do still have limited resources. It is a fairly defined problem we're trying to fix. So let's make sure we're not going into ultra technical detail on minor points that aren't really shifting the needle that much. And I think the point that we probably need to reflect on the most as staff is the one Lynn raised that Todd just reinforced, is other national standard setters who are using IFRS and or IPSAS standards have already adapted IS 26. So let's not try and recreate the wheel too much on how we might do that. For the sake of a standard setting project, let's look to the learnings of national standard setters, either their own standard that's not IFRS based or an adaptation of IS 26, and look how we actually deal with these issues rather than being too open-ended on how we're going to deal with them. Because if we are going to go through the longer list of issues and kind of look at them each conceptually and pure, I can see this taking more resources than what we've got in store here. So we will need to be quite careful in how we work this through as a staff and a board on this.
Okay, so thanks for those final comments, Ross. Thanks everyone. I think that's been a very useful discussion. I think it's underlined why this is going to be a really important project from the transparency and accountability perspective, should really move us forward. So I think you know, that has come out very, very well through that discussion. So with that, and we will see an updated project brief back in advance of Tuesday for hopefully for a vote at that stage. I'd like to move us on then to the next item, which is item 4, which is the education session on the other possible limited scope project on operating segments. And Gwenda, you're going to present on that. So thanks, Jo.
Yes, thank you, Ian. So I'll share my screen and introduce you to the session. It has 3 parts, and beginning with segment reporting as it's presently done with IPSAS 18 in our suite of IPSAS standards, then looking at the IFRS 8 operating segments, and finally highlighting some issues to address. And after each of these separate parts, I'll pause for comment and, of course, discussion and board reaction. There's also scope to pause during the presentation, Ian, if you feel that there's a need to do that in other places. And I just wanted to highlight that what was proposed in December was a limited scope project, similar in concept to what we've just been hearing discussed, I've heard discussed, to do with the retirement plan project, with the idea that exposure drafts are out to be discussed, and this is an opportunity to pick up a relatively straightforward alignment project. So when looking at these 2 different standards, IPSAS 18 and then IFRS 8, I've taken a 3-point analysis approach, because any standard about segment, there'll be detail, but basically what it will be doing is looking at 3 main things. First, how are you going to identify your segments? And secondly, what disclosures should be made for each segment, and how are you going to identify those disclosures? Thirdly, the quality of disclosures, and I use the word often of what underpins the disclosures. So how does the standard support, underpin good quality segment disclosures? And what you'll notice as we go through these 2 standards, that there's a kind of a what question, a specific item question, but also there's very much a how approach. How does the standard do this? So first of all, I'll jump into IPSAS 18. IPSAS 18 is one of the IPSASB's oldest standards. It was developed in 2002. And it's based on an even older standard, which is IAS 14, which was developed in 1997. And I noticed in the discussion we've just had, Arjit mentioning, well, this other standard has a kind of an old feeling. And I think that would be true with IPSAS 18 as well. It has an older style of expression. If you look at the comparison table at the back of IPSAS 18, it explains that it's drawn primarily from IAS 14. I want to emphasize, though, that there were some major changes, and these affected identification of segments, and IPSAS 18 used a new approach designed to meet public sector needs. There's also some changes to do with extent of disclosures. And this standard was difficult to develop. It needed to be re-exposed, which was very unusual in those days for the Public Sector Committee, the IPSASB predecessor. And the main reason for that was that the way it had introduced a new approach for identification of segments. So what is happening with the way that IPSAS 18 identifies segments? Well, unlike IAS 14, it actually uses a principled approach for this. And this is kind of a multiple criteria, but overarching everything is you identify your segments with a view to making sure that they provide information that's useful to assess past performance, accountability, and to make decisions about allocation of resources, so decision usefulness. You look at internal reports, and the idea is that these are reports going to senior management or governing bodies, and the standard gives examples of this from a public sector perspective, saying budget documentation may be relevant to identifying segments. The GFS functional classification for government, that lovely acronym COFOG, could be relevant to this. And also portfolio responsibility of ministers or members of executive government. So the guidance on identification of segments is focused on public sector needs, and it uses a principled approach, which is different from IAS 14. Secondly, then, when you look at the second point in this analysis, what's happening with disclosures? Well, IPSAS 18 specifies what disclosures must be provided. It lists them: assets, liabilities, revenue, expenses, and detailed subsets of those major lines. So in that sense, it's similar in how it does things with IAS 14. But it does have some public sector differences. And I want to highlight the main one being that there's no requirement for a segment result. Entities can provide one if they want to. IAS 14 did require this, but this was not seen as essential in a public sector context. And there's some other disclosures which are not required. And I can provide detail on that, but I wanted to keep this presentation at a reasonably high level. Now, the requirements that underpin disclosures, the approach being used is very similar to IAS 14. And when you think about the way that an entity has to deal with this issue of disclosures for segments, you have to divide up items into different segments. And the IPSAS 18 has definitions of what those segment items are. It has accounting policies for how to derive them, for example, how to measure them, and some other requirements where I wanted to highlight issues to do with attribution of items to segments. Because when you have cut up your financial statements and you have to say, is this asset really about this service segment or that service segment? Is it about this geographic segment or is it about the north or the south? And it may be being used for two different segments. So the standard provides guidance and requirements on how to attribute assets, how to attribute, for example, liabilities. And we've just had the discussion about pension liabilities. As they're incurred, the staff may move around from segment to segment. So how do you make the decision that a liability should be shown under one place rather than another? And if that's not really possible to do, you know, what's the limit for that? And so that was the main thing that I wanted to highlight in terms of IPSAS 18. And I now want to stop the share in order to allow people to provide comment if Ian's agreeable.
Thanks, Glenda. Yeah, just take any questions or comments from members at that stage. No, so I think we're good, Gwenda. So if you want to take comment into introducing IPSASB.
Great. So back to the slides. Here's a nice picture. It's the provincial governments of Ontario on one side and the view from my apartment looking uptown towards Bloor Street in Toronto on the other. So moving from IPSAS 18 to IFRS 8, I wanted to highlight, first of all, that there's a shift of scope. So the public sector standard is focused on any public sector entity and it applies to all. But IFRS 8 is talking big business. So it's focused on companies that have traded, publicly traded debt and equity. And there's a sense which will come through in my next comments that there's a working assumption in IFRS 8 that internal management is producing this information already. And what investors want to see is they want to see that information out in the open. And they want really to see what the inside management is doing. Now, as I noted with IPSAS 18, it requires it tells entities what to show. And you could say that that might be cutting across what is being actually happening internally. And to some degree, that was a deliberate decision from a public sector point of view to do that. And again, I could provide some detail that shows that the standard, yes, principled approach to identification of segments, but there were some limits to that. And the standard is very clear that if you're only doing an inside budget versus outside off budget approach or general government sector approach versus everything else, that was unlikely to meet the needs of segment identification for the public sector. But for IFRS 8, the working assumption of the viewpoint is that the internal management information is what investors want to see. And that's what the standard should try to make come out into the open. Now, IFRS 8, like IPSAS 18, though, it has picked up on this principled approach in IPSAS 18, and it's using it to identify segments for business needs. And it's a slightly different principle. It's got more of a business flavor to it, enable users to evaluate the nature and financial effects of business activities and their economic environments. It's still very broad, and that's what's meant to be driving segment identification fundamentally. Then it's supported with a very clear statement about in identifying segments, the preparer looks at what's happening internally with internal reporting. So, and they introduce this defined term, the chief operating decision maker. If that person regularly reviews component information, those components are probably segments that should be reported externally so investors can see that. But there should also be discrete information available. And this is a bit like a justification because one of the major criticisms for IAS 14, and I believe it's also one for IPSAS 18, is disclosure overload, being forced to require this extra information. And in IFRS 8, the argument is basically, well, you should already be preparing this internal information. We're just asking you to get it out into the open. Finally, segments will have business activities that are revenue earning and expense earning. So that was point number one. One more important thing here, though, is that IFRS 8 requires that if segments are at a certain, or I should say components are a certain size, if they're big enough, then they need to be reported externally. So it has a quantitative threshold in the standard. For example, if the revenue is 10% or more of the combined revenue of all operating segments, then that should be reported separately. Don't put together two segments. You know, I've dealt with this in the UN system. You know, it's like we'll go 50% here, 50% there. Now with IPSAS 18, you can do that. You can just have two segments because there's no quantitative threshold, although there is an overarching principle which would suggest that's not a good way to go. But when IPSAS 18 was developed, this quantitative threshold was in IAS 14, so it could have been brought across. But the board of the day decided not to. So that's the first thing to know. The second thing that IFRS 8 has, and this was new to IFRS 8, it was not in the old standard, is an aggregation criterion. And again, you can think of this as a way to reduce disclosure overload, acknowledging that in certain circumstances, you can put segments together, but basically they must be working the same way. So the principle for aggregation, the criteria, is that everything's the same. The nature of the products, the services, the production processes, the regulatory environment, the customers, the distribution method, and they must have similar economic characteristics overarching, so that in that case you can aggregate. Now, this was not in the old standard, IAS 14. And so when the IPSAS developed IPSAS 18, it didn't consider this as something that they could put into the standard, and it's not in there. So in terms of the first point, segment identification, these are two more differences in terms of what IPSAS 18 is doing compared to IFRS 8. The second point, disclosures, this is where I think it gets really interesting with IPSAS 18, because it takes the principled approach for segment identification, and I've already hinted at this, it rolls it out into what you have to disclose. And it says, if the information is used internally, it should be disclosed. And it basically also says, but if not, you don't need to. So there's one exception to that, which is for each segment should show a measure of profit or loss. And of course, that's a major private sector interest, profit or loss. But then other items, and these are listed as possible disclosures, total assets and total liabilities, they should be disclosed if regularly provided to this chief operating decision maker. And further breakdowns, and there's quite a detailed list. And again, I didn't drill down into that in this slide, but the critical thing I wanted to hit on is this idea of a principled approach to the actual what information, unlike IPSAS 14, which gives you a list and says you have to do it. Here, there's an overarching principle. You want to disclose information needed to evaluate the nature and financial effects of activities in their economic environments. And again, as I mentioned, this idea that the approach being used, if amounts are regularly provided to the chief operating decision maker, they should be disclosed. So that could be more than the list that is actually highlighted in the standard. Potentially, and it's all about the external investors getting a look at what management is seeing, and that information is what's really going to be useful to their investment decisions. In terms of the quality of information, what I think of as the underpinning, there's actually also basically a principled approach, that it's supported by kind of like safeguards of making what's happening explicit. So again, the approach is that the information, the measurement approach used internally should then flow into the external reporting. And that measurement approach could be different than what you're reporting in your primary financial statements. And potentially you could have other differences. But what is essential is to get the inside information looked at by management out into the open. And to assure information quality, there's both the working assumption that management wants good information and will get it and can get it. But there's also a lot of explanations and reconciliations required. So I've highlighted, for example, that preparers are required to explain the basis of accounting for intersegment transactions and the nature of differences between segments' profit and loss and entities' profits. They have to describe the factors they use to identify the segments. They have to explain their aggregation criteria judgments and also provide information on products and services generating for each segment revenue. So those are the 3 points I wanted to highlight in terms of IFRS 8 and the way it differs from our present IPSAS. So I'll just stop here for a moment to let board members provide comments or questions.
Thanks, Brenda. Open up for any questions, comments from board members. Yes, Mari.
Thank you. Thank you so much for the explanation. And from my point of view, it is very difficult to identify the segment in the public sector. And segment should be related to the public sector's outcome, and so the output and outcome. And so from my point of view, segment should be based on the responsibility accounting. So responsibility segment is so important concept in the public sector. And so in the private sector, the performance measure is based on the profit or loss. So its performance indicator is so simple. And so my question is that how we consider about the public sector segment identification, the disclosure issues compared with the private sector disclosure and segment identification issues. Thank you.
Thank you, Mari. That's a very good point. I'll take Lynn and then perhaps go back to you, Gwenda, for you to answer the points raised. Lynn.
So mine was just more observational than a question, but building a little bit on what Mari's just said as well. I guess our experience in the UK of implementing IFRS 8 in the public sector has been an interesting one for me. We had difficulties around deciding who the chief operating decision maker is. Is that always clear? We then had a lot of public sector bodies arguing that the chief operating decision maker didn't see segment information. So there was an incredible reluctance to disclose segment-based information. I think that reluctance was characterized a bit by the fact that the decision makers within the organization weren't seeing information based on the same basis as financial statements are prepared on. And so the disclosure of what was seen by the chief operating decision makers in a segment way highlighted that certain elements of the financial statements that are like, for example, depreciation aren't monitored on a management accounts basis and an internal basis for decision making. And so there was a lot of explanation needed in the reconciliation between what management used to make decisions and what is then displayed in the general purpose financial statements. All of which was quite interesting because it does throw a spotlight on, are they really managing on a segmental basis, using all relevant information that we see in general purpose financial statements or not? Quite often not, because budget is king and you manage against the budget rather than on a performance measure in the way that we measure performance in the financial statements. So we did have quite an interesting journey in implementing IFRS 8. And I guess quite a lot of challenge from public sector bodies around its applicability in the public sector when you are not measuring performance in the same way that you measure performance in the general purpose financial statements, which is picking up the point that Mary made. And I guess, you know, for me, there is interest. I guess it's, you know, another difficulty is what do users want to see on a segmental report in the public sector, and is that the same as the private sector, question mark?
Thanks, Lynn. Gwenda, I don't know whether you want to make comments on those at the moment, or you want to pick them up in the next segment of the presentation.
I wanted to provide a brief comment back, which is to basically, I think both comments highlighted some issues to think through, perhaps, and with this project. I know from a New Zealand perspective, I kind of thought that New Zealand must be doing this because of the output and outcome reporting and dividing. Any public sector entity will be reporting on its services. So that picks up Mira's comment. And yet, as I've discovered, that New Zealand is not using a segment accounting standard. And so there's some kind of difference there to do with adding all that financial information. I see Todd and Bernhard have put their hands up. So that's a good point. And yes, what Lynn's highlighted in terms of what's going on inside, you know, is it a transition issue, which we encounter so often in the public sector, that there should be segment reporting happening inside, but there's not. But just to acknowledge that IPSAS 18 includes words that show that the developers of that standard appreciated there might not be much happening inside the entity. And nonetheless, they were saying, you know, there should be segment reporting, and we're going to tell you how to do it. So that's my reaction. Thank you to those two good questions.
Okay, thanks, Gwenda. So Todd, I think just to you first for a sort of right of reply to what Gwenda has said, and then I'll go to Bernard for his point. Okay.
Yeah, thank you, Ian. And yes, Gwenda, you're right. New Zealand has not adopted a segment reporting standard for the public sector. And probably the main reason for that is a lot of entities in our public sector have got to do service performance reporting. So we've got a recommended practice guide in IPSAS around service performance reporting. A lot of our legislation actually requires that sort of reporting, and that reporting needs to work with financials. And so when you're reporting on your service performance and linking it to the financials, you're getting a particular cut, I suppose, around the way that you segment, and the actual segmental standards, whether you look to IFRS or the IPSAS standard, did not work with our legislative framework. So that's the New Zealand experience. I think when I start thinking about this as a project, I do think we are going to struggle a little bit in terms of getting all jurisdictions to align around something here. I think you'll struggle with New Zealand just because of our legislative situation. But when I look at IFRS 8, I don't know whether the principles on which IFRS 8 are based actually are going to work in general for the public sector. So I don't see this as an alignment project, really. I think we would need to actually really think about what we're trying to achieve here. What is it that we're trying to solve here from a public sector perspective? And I think we may end up in a different place. So that's sort of my concern, I suppose, with this, that it's not a simple project. It's actually going to be quite a complicated one.
Thanks, Todd. And I think you sort of, you know, going back to Murray's original question, I think that was sort of picking up on the approach in New Zealand is sort of along the lines that Mari was advocating in terms of focusing on outputs and outcomes and so on. But I think it is interesting to hear that in practice. Now, I'll take Bernard's comment. Mike, I'd like just Gwenda to finish off on our presentation, if that's okay, before I start to take a round of comments. Bernard, to you, and then back to you, Gwenda, to finish the presentation, and then I'll open up for general discussion.
Yes, just going to make it very quick. Totally agree with the points Marilyn and Todd raised on the issue. I think it's the really interesting part here, really, to me, is that, I mean, we are getting in the field of budget reporting to some degree, because like it's been said, I mean, that's the major instruments of reporting on those issues. And if you have a mismatch on how you compile your budget and how you compile your accounts, then I think we get into the notion that there is a public interest actually in the difference. So if you have a purely cash-based budget and you have an accrual account reporting system, and you just you report on the cash accounts actually when it comes to programs and segments, then obviously there is an interest, I would say, in kind of, so how does it translate to your accounts? If you're on the same basis, I think the problem is different. I mean, like Todd said, there's still an issue, especially when it comes to non-financial reporting elements. But I think at least you are on the same basis, and you're talking the same language. And maybe another notion on the IFRS 8, I guess, which is valid for the private sector, is the question on how public is decision making actually in a large corporation. And of course, usually it's not very public. And again, this differs from jurisdiction to jurisdiction, but generally speaking, public decision making in the public sector is at least more, I would say, under the public eye and under public scrutiny than it is in the private sector. So you don't have the same particular issue to kind of get some transparency in the process in the same way than you would have in the private sector.
Thanks, Bernard. Very interesting. Gwenda, back to you, and then to complete the presentation, and then we'll open up for some more comments from members.
Thank you, Ian. And yes, it's great to hear these comments coming through. In terms of the third part of the presentation, what I've done is highlighted, therefore, the issues that arise at the sort of the big issues. There'll be detail as well, but as the board considers this project of moving from IPSAS 18 to IPSAS 8, and really these issues flow out of the comparison of these three main concerns of segment reporting. So yes, IPSAS 18 already has a principle for segment identification. It has public sector focused approach in terms of what we mean by internal reports. Would that be brought across into IFRS 8, which has a business focused principle? And as Lynn mentioned, this idea of the chief operating decision maker can be difficult, you know, if you simply pick up IFRS 8 as it is. So what will the board want to do about the segment identification principle? Then in terms of disclosures, IPSAS 18 requires them. IFRS 8 leaves it up to management. And we've already heard this question of, but what is management actually doing if we rely on them to decide what to disclose? Again, there's the basic adaptation for the public sector, you know, not so interested in profit and loss, which was the IFRS 8 central concern, more interested perhaps in the amount of revenue, expenses, costs, of course, expenses. And again, I think I'll touch lightly on the next ones, just quality of disclosure. Can we rely? So I feel a bit mean about the public sector when I say, can we rely on what management is doing? But maybe it's very relevant when people are starting into accruals. The difference in amount of guidance is clear when you just look at the length of these standards. And again, coming back to Ajit's point in the earlier discussion, I think the board would be looking at moving, if the guidance that's in IPSAS 18, if it's brought into an aligned IFRS, we'd need to sort through and apply the decision tree that's been used previously to decide what should be application guidance and what should be implementation guidance. So that's the first set of issues to consider. I did not the wonderful analysis that Joe did, but I did have a quick look in the time available at jurisdictions. We've mentioned New Zealand and the UK, and Australia, from what I picked up IPSASB, I forget the number now, I did have it, but they have picked up IFRS 8. They seem to be using it in the public sector. It's without change, and I've looked at the standard, and the scope is focused on the entities with publicly traded debt and or equity, but that would capture a lot of entities in Australia. That would be all your municipalities, your provincial governments, but it wouldn't be capturing the way you do in New Zealand, where IPSASB applies to schools and universities and hospitals, which are less likely to have publicly traded debt or equity. The UK central government, I did one last check of this. The financial reporting manual does use IFRS, and it describes it as not adapted or interpreted. There is actually an interpretation for applying it, though, to whole of government. And I'm open to correction, but when I tried to look down at what local authorities are doing, it looked as though they're not applying IFRS 8 anymore, because they had a comment about telling the story approach replacing segmental note disclosures. So I think I'm open to correction there, but I think that there's a difference in the UK between central government and local government. Now, South African, though, they had picked up IFRS 8 and adapted it for the public sector. And I wanted to highlight, though, the changes they made. And the scope is for all entities, so that's immediately compared to IFRS 8, one change. And then there are changes to the way terminology works, pretty standard public sector changes, but more, if you like, a bit more extensive. And certainly the segment identification using a principled approach, but public sectorized. And the disclosures, some differences in terms of items and underpinnings, and there's a difference in terms of transitional provisions. And I wanted to highlight something which I have highlighted it before, but the South Africans looked at this issue of a quantitative threshold. Remember, in IPSAS 18, there was a deliberate decision not to have it. And the South Africans in GRAP 18 made the same decision. So there is no approach of having a quantitative threshold above which you must report a segment. But they have used the aggregation criteria. And Lindy, I hope you'll be happy to talk about the process and the learnings there. But I thought, that could be a basis for identification of issues and as a good starting point. So we're really left with this question of a narrow alignment project. That's what's been proposed in December. That suggests logically that very little is going to change between IFRS 8 and IFRS aligned IPSAS. Okay, and yet we can look at different experiences. Australia has just picked up IFRS 8 and run with it. By contrast, South Africa has identified a need to make, I guess, fairly extensive public sector changes, even though it's basically now talking about we've adapted IFRS 8. We have this improvement in terms of aligning with the IFRS, which is one of the driving factors for this project, for the IPSASB as well. So I'll stop my share and hand it over back to the board.
Okay, so I think I might just ask Lynn or Lindy whether there's anything they wanted to add just in terms of the points that Gwenda had made. I should just note that the reason the photo was on the bottom of the South African slide was actually that was our board meeting in Stellenbosch at the end of 2016, and that was a very nice meeting. Those who were there for that remember that. So Lindy or Lynn, anything you want to add or clarify in terms of what Gwenda said? Yeah, Lindy.
Thank you. So I guess with the scope and the non-inclusion of the thresholds, we kind of took a decision that from a public sector point of view, this information would be important from accountability purpose. And so therefore, there shouldn't be any, I guess, exemptions from entities or what you would disclose, because it was public interest information. And so it would have to apply equally to everybody. But we did have the aggregation, obviously materiality would also apply. We did wait a while to make it effective because we knew there were reforms happening specifically in local government around how they structure, how they do their budgeting. So we did hold back a bit because we were doing a lot on the chart of accounts. And I think the standard is quite dependent on how the entity organizes itself. And so it's only been effective for a year in local government in particular, because it was important to get an understanding of the difference between the budget reporting, the performance reporting, and the segment reporting, and we needed some stability before we introduced the standard as well.
Thanks, Lindy. Could I just ask I suppose a question which is just useful, and then I'll go to Lynn, but I'm kind of interested that you went to IFRS 8 rather than IPSAS 18. Was there a sort of discussion about whether to pick up IPSAS 18 or to go straight to IFRS 8? Just interested whether that came up.
So our standard was based on IPSAS 18 originally. And then when the IFRS came out, the board decided, well, let's have a look at what's in IFRS 8 and see if it was useful to include some of those concepts. So similar to the exercise we're doing now, that is the approach the board took. So it was first very much aligned to IPSAS 18, and then we went and adapted it further to bring in some of the concepts from IFRS 8.
Thanks, Lindy, that's helpful. Okay, so Lynn, just a point of clarification, and then I'll go to David, who's been waiting patiently.
Yeah, the point of clarification is that we have adopted IFRS 8 in the local government sector, so we've adopted it across the whole of the UK. I suspect the references you're referring to, Gwenda, are equally, particularly in local government. We've had a lot of criticism for the volume and length of local government financial statements and the volume and length of disclosures. And IFRS 8 was one area where we did get some criticism about the volume of disclosures. So some cross-references were made to not repeating things within a set of financial statements and trying to be sensible about how you tell the entire story whilst meeting those requirements.
Thanks, Lynn. So David, go to you and then to Mike.
Okay, thank you. First of all, I'd like to thank Gwenda for the presentation. I find that extremely useful, which of course, as usual, would then prompt me to ask a question. And I think my first question is, well, what is the problem that we are trying to solve? Is there a problem that we need to solve? I mean, I don't think, sort of listening to a couple of the other comments, particularly New Zealand, sort of thinking, well, we won't adopt IFRS 8 because the requirements to produce this type of information exist elsewhere. But I was actually very interested in Lindy's comment about how they started and what they, I mean, Lindy will correct me when I get this wrong, but what they've done is they started with IPSAS 18, had a look at IFRS 8, thought, well, there's a few bits that could be useful. We could, and then we, if you like, update IPSAS 18 to meet the South African requirements. Couldn't we do the same? Couldn't we actually not do this as an alignment project with IFRS 8, but actually say what we're going to do is update IPSAS 18 and use some of the material that's in IFRS 8 to make it more streamlined, so perhaps to meet some of the criticisms that Lynn's mentioned and perhaps reduce some of the disclosure requirements, for example. And I just wonder whether that might be a better way to look at this.
Thanks, David. So we'll take Mike, and then we'll sort of talk about what might be next steps. Mike.
So thank you, Chair. I suppose a couple of things. I'll just mention quickly what is actually happening in Australia. So in Australia, the standard only applies to those entities who've got debt or equity instruments that are traded. So I'm not sure that you're right, Gwen. I don't think we actually do apply the standard in the public sector. In my jurisdiction, we do, however, as Mari's mentioned, have output-based reporting, and the outputs are budgeted and they have to be reported in monthly management accounts and in year-end financial statements. And those budget outputs are, for example, in health, there'd be 4 or 5 outputs and they have to be reported every year and explanations provided for variances against budget. So that's something we just do at a jurisdictional level, not because there's a standard. At a whole of government level, we do apply the concept of the functional expenditure, which I find useful, but it doesn't do that for the balance sheet. It only does that for the P&L account. Although we do show the classifications that I think are the GFS classifications around the general government sector, the public financial trading corporations, and the public financial non-financial corporations. So that's really useful at a whole of government level, but obviously doesn't apply at an entity level. So I'm trying to find, again, the question, what are we trying to solve here? I'm not sure what's the public interest in. You raised that early on with the previous discussion. I'm not sure we're going to pick up something in Australia that is going to be necessarily aligned with IFRS 8. But maybe David's solution is a better one. Let's take our existing standard and see how it might be adapted to make it more useful. IFRS 8, I don't think it's going to give us the answer.
Thanks, Mike. So I think the what's the problem is kind of at the root of this, and it's kind of, I just sort of reflect on anecdotally, this is the standard that people have bent my ear on a number of times as chair, and I even perhaps slightly facetiously go back to almost one of the first things as chair was I got taken to meet the finance manager for IFAC, and a lady called Meg Waterhouse, and IFAC uses IPSAS. And almost her first comment when I met her was, "What are you going to do about IPSAS 18?" Kind of, I've had sort of similar comments a few other times, and I know Ross will probably sympathise because I know he's had Meg, sort of bending his ear and getting his advice on how to work this. So I think the question is, there obviously are some practical issues in the application of the existing standard, which is probably why there's a question about should we do anything. But then probably the question is, so there's this sort of, what are the pros and cons of doing nothing? There's always the do nothing option for, in these situations. I thought the point that Lindy or the South African experience is obviously worthwhile exploring in some more detail, because whether you regard that as application of IFRS 8 or actually it's sort of take IPSAS 18, which was itself an extension of the original ISB standard, and update it, looking at IFRS 8 is perhaps a moot point. I don't know, Lindy, you might want to come back on that. But it seems to me perhaps in terms of, thinking, firstly, do we think this is something that actually needs a project? And then secondly, is this just limited scope or is it something more fundamental? you know, probably we need to have a look more at that South African experience and understand what was debated and discussed, and if you like, what the differences were between the current standard and IPSAS 18. And I think that goes back to what's the problem we're trying to fix here. Lindy, I don't know whether you want to add anything at that point.
Yeah, so I won't be able to answer it now, but I think what we could do is also give an indication of where we differed from IPSAS 18. So if there was a difference in the first place, what those were. And then it became a, let's simplify it and let's look at IFRS 8 for some simplifications, but there were some adaptations or amendments that we made that was in IFRS 8. So we just have a definition of management, for example. We didn't go into who's this chief person. So there was some further simplifications and some of the entity-wide disclosures we didn't include. But I mean, we can work with staff and maybe give you a summary of our journey and where the differences were and where we landed up.
Thanks, Lindy. I think that would be helpful. So I think we, you know, probably before we do anything further on this, I think we probably need a better articulation of the sort of problems that I referred to. And Ross, I think you can probably, you know, having dealt with Meg on that, probably have a fair idea on that. But I think it would be useful for anybody else on the board that has experience of the challenges of either using the standard in practice or perhaps in terms of implementation of the existing standard in practice, what's given rise to problems. So if we understand what the nature of the challenges are with the existing standard better, and then I think that offer from Lindy would be very helpful, because that would give us a very clear view on what might you change and why in moving from a sort of standard based on from IPSAS 18 to a standard either taking into account IFRS 8 or based on IFRS 8. And I think we'd then be able to evaluate as a board whether we actually think there really is a need for significant changes, or perhaps a few incremental changes to IPSAS 18 would actually get us to a place that better met the needs of our users. I think in that analysis also the other thing that we would need to think about is the sort of, you know, the issues that New Zealand picked up on, I think, and go back to Mari's original point about if you know, it's more appropriate to focus on service reporting and so on, you know, how does that interface with the segment reporting standard? People happy with that as a sort of, you know, if you like, three-pronged way forward. Lynn, additional comment from you?
It was a question for Ross and Gwenda, I guess, really is, how does that sound compared to what you had envisaged for this project, particularly in terms of level of resources and priorities, I guess?
Ross, well, to me, I knew that this was one of the possible outcomes of the discussion, given when I looked at the standards, but that in terms of resources, I'll hand it over to Ross. I would think it an interesting way forward, and something that I'd be happy to be involved in.
Ross, over to you.
Yeah, I think hearing the discussion and the different ways we might take it forward, I think there are potentially more complexities in this than if we were just to take a straight IFRS alignment project. So I think we'll have to do a little bit more research on what the problem is and how we might fix it. And then in the different ways we might address the problem, what we think the resource needs would be. Kind of listening to the discussion and knowing we have the work program consultation coming later this week, it did kind of feel to me like what we might be looking at here, what might be a better approach, is more of a post-implementation review of IPSAS 18. And then in taking it forward, considering how we might inform that way forward to bring in some of the concepts from IFRS 8, if possible. But I think Todd's raised some interesting points on a jurisdiction that's using IPSAS directly and chooses not to use IPSAS 18 at all. So for me, understanding how they're filling that information need and the need for the standard as a whole feels like an important consideration going forward. And maybe you have different considerations at different levels of government. So I do think there could be quite a bit of complexity built into this project, and we need to, again, further define what the problem is and how we can address that problem. And there'll probably be more than one way to address it that we'll have to choose between. So, you know, the limited window we have now might not be sufficient to address that, but it might also be too soon to make that decision. We might have to wait till June to make that call. But that's kind of my reflection off the cuff without having to sit back and kind of digest what we've heard.
Okay. Thanks, Ross. Mike, I'll take a final comment and I think we'll wrap up for today.
Thanks, Ian. Maybe I'm coming from left field, but I suppose, Ian, at least, Ross, as you go through that thinking, if it might be better to think of another project instead, look at related parties, I don't know, but maybe just think about, once you've decided what you want to do or don't want to do, is there another project you might want to look at?
So, I mean, I think on that, I think let's just stick to this question as to what, if anything, might we do with it. So in terms of thinking about it, I think we have that, you know, let's collect any more information that we have from around the board in terms of what might be the nature of the existing challenges people are finding with IPSAS 18. I think we need more information about the South African journey from IPSAS 18 to an IFRS 8 based standard. And there's a bit of thinking just to understand the, if you like, the alternative approach, which is based on, or the conflict between a segment-based approach and the approach that New Zealand is taking. And I think that gives us a better problem definition, if you like, and options. It sounds, based on what Ross has said, that this is not something that fits within the sort of limited scope alignment window that we've talked about. It probably falls as, having identified that, then there's actually probably it fits more in the list of potential proposals for the mid-period work programs. So if we can ask staff to do those, you know, look at those additional pieces of research, then that would feed into our deliberations, I think, on understanding whether this is something that we could pick up in that mid-period work plan and propose it through there, or whether it just goes on the longer list of projects, you know, but with some clear rationale from the board as to why we've not picked it up at the moment. So I think that probably is the sort of summary of the way forward. Ross, is that okay is that clear from a staff perspective?
Yeah, I think it is. The one thing I was going to suggest, that if any members, TAs, or observers are coming from a jurisdiction that uses IPSAS or national standards based on IPSAS or IFRS, if you could just ping us an email and tell us what standard you're using for segment reporting, and if it's not IPSAS and you're an IPSAS based, why not? That might help get us focusing in the right areas on the research on that next phase. If you could send that to Gwenda, myself, and in CC.
Good. Okay. Well, thanks everyone. I think that has been a very, you know, good presentation, Gwenda, useful discussion.
Thank you.
With a lot of input there. And I think we can then decide better, when we've got those additional pieces of information, what, if anything, we would propose to do that at this stage, or at least if we don't propose to do anything, I think we have a clearer basis to, you know, state why we're not proposing to do anything going forwards at this stage. With that, I think we come to the end of today's session. I think, you know, we've had good discussions on those two topics. We've got a way forward now on the reporting on pension plans, further analysis to do on IFRS 8, and segment reporting. So with that, we're finished for today. Tomorrow we come back and start to look at the way forward on the revenue exposure drafts ED70 and ED71, and that's the focus for all of tomorrow's session as the first part of our discussion, which we also have provision for next week. So thank you very much, everyone, for good discussions today, and look forward to seeing you again same time tomorrow. So thanks, everyone.
Have a good day.
Bye, guys.